In this section of the lecture, I'll be providing a third perspective on economic development in Asia by giving a brief perspective on the history of economic development in India. India is an interesting case study in economic development for several reasons. First of all, it fits the pattern, for example, of the high-performing Asian economies that we looked at in the last section, of having displayed, compared to historical standards, relatively high rates of economic growth in the second half of the 20th century. Yet that growth has been slower than in a lot of those high-performing Asian economies. Secondly, India's path to economic development in the second part of the 20th century has been quite different to the path that Japan and the other high-performing Asian economies followed. Thirdly, India's huge population, over 1.2 billion, obviously means that changes in economic development are hugely significant on a global scale for thinking about human well-being. At the start of this section of the lecture, I'm going to give a little bit of an overview of India's economic growth experience over the last 150 years or so. Starting out with some data on the average annual rate of growth in GDP per capita. And there's a period from 1860 to 1950, which I have identified here. So that is roughly the period when India was a British colony from 1858 to 1947. And you can see that there is very slow growth in GDP per capita if you look over the whole of that time period. Then there's a second phase, the 1950s to the 1970s, which is really the phase where there's a high degree of planning in the Indian economy. And you can see that under that planned economy model, India achieved rates of economic growth that were above what it had achieved over the previous 100 years or so. Quite high rates of growth by comparison. But you also observe the level of the rate of growth slowing as we move from the 50s through to the 70s. Then we have a third phase, which is from the 1980s onwards, where we have relatively, by historical standards, higher rates of growth in GDP per capita in India and accelerating, particularly in the 1990s and the 2000s. So these are high rates of growth, and the growth has been getting faster as time goes on. This graph, I've shown the four economies that are often called the BRIC economies: Brazil, Indonesia, India and Russia, just to give you a comparative perspective on their level and growth. Russia's up the top here, so we'll talk more about Russia in the next lecture, but you can see once the separate state of Russia is established, there's an initial period of transition when they're moving from the communist system of government, socialist system of organising economic activity, and then a recovery after that. And out of the countries, Russia has relatively high levels of income. Brazil, you can see, has been growing fairly steadily since back to the 1950s, in some ways sort of faster growth up to 80s, and then a little bit slower after that. And then you can see India and Indonesia having quite similar growth paths from the 1960s onwards. So in the case of India, you can see sort of the point about some growth in the 50s, 60s and 70s. Then you can sort of see that accelerating in the 80s. And the fact that this line's tilting up tells you that the rate of growth is accelerating or getting higher as time goes on. This graph is just to give a perspective on population growth. So I guess you know India is a large country, so that what happens there, obviously, if we're thinking in terms of human well-being on a global scale, is very significant. You can see here the evolution of population back in 1820, about 200 million. in 1950, about 400 million, and then up to the point now where we've got around about 1.2 billion. So one point about this, and the other point is that there's similar sort of evolution for China, but India starting converge towards China towards the end of this period. The other thing to note about the graph is that obviously the rate of population growth has accelerated from 1950 onwards. So the population basically is doubling between 1820 and 1950, 130 years. Then from 1950 to 2010, which is 60 years, it's pretty much tripling. And so that gives us an extra piece of information to interpret the data on GDP per capita that I presented in the last two slides, which is that in the period from the 1950s onwards, India has had more rapid growth in GDP per capita, and that's occurred at the same time as its population's been growing more rapidly than it did in the previous period. So that's really to suggest that the achievement of development in the period after 1950 is more significant because it's occurred at the same time as there's been this rapid growth in population. The other introductory piece of information that I wanted to provide was just about the composition of economic activity in India. And this is a table which tells us the percentage of employment in different industry areas during the 20th century. And so the big point to take from this is that India is predominantly an agricultural economy. It was predominantly an agricultural economy at the start of the 20th century, but it remained predominantly an agricultural economy even once the rapid phase of economic development had commenced in the 1990s. And the second thing to note is that to the extent that agriculture is accounting for a smaller share of employment over time, that's not because, as with the case of, say, the high-performing Asian economies, that there's been a transfer of workers to work in industry. Rather, it's been the service sector where there's been an increase in employment, particularly in the period of most rapid economic development from the 1980s onwards. So this is just to, I guess, suggest that an important theme later in this section of the lecture is going to be the nature of the composition of economic activity in India, how that's affected India's economic development, and how that compares with some of the other Asian economies which we've been talking about earlier in this lecture. What I'm going to do for the rest of this section of the lecture is talk about India's economic development really in three phases. The three phases that I identified when I looked at the first data slide, where I said that there was the British colonial era, then there was the planning era from the 1950s to the 1970s, and then a period of faster economic growth, which is often referred to as the reform era, which happens from the 1980s onwards. So starting out with the colonial era, so there was British rule in India from 1858 to 1947. As we've just seen, India during that period was primarily an agricultural economy with about 70% of its employment in agriculture. And Tirthankar Roy, leading Indian economic historian, has described the fundamental nature of economic activity at this time as being an abundance of poorly equipped labour engaged in occupations subject to high climatic risks. So he's saying that the economy was based around agriculture. It was relatively low technology agriculture, and it was an area of economic activity where there were there was the potential for substantial shocks to affect the level of output, in particular climatic risk. So in India, there's a stylized characterization would be to say 9 months sort of without rain, 3 months of monsoonal rainfalls, and a high degree of sensitivity in the amount of agricultural output that can be produced to the amount of rain in those monsoonal months. So if those rains fail in any areas, then historically it's raised the risk of famines, for example, or significant food shortages in those areas. And so economic historians of India generally argue that that climatic uncertainty, the uncertainty of the amount of output that could be produced, has had significant effects on investment and demographics in India. First of all, the uncertainty of return from agricultural activity has discouraged investment in agricultural activity, investment in technology, discouraged investment, also prevented farmers building up the funds which would be necessary for investment. So through different mechanisms, investment's been deterred, which has meant that agriculture remained a low technology activity. It also meant that because of the uncertainty of future food supplies and the risk of famines, that India's birth rate has been higher than it would have otherwise been as families seek to insure against potential negative shocks such as famines in the future. Now, over the whole period from 1858 to 1947, we know the main story is of relatively slow growth. But if we look within that period, in the 19th century there was some improvement in agricultural output, but then stagnation in agricultural productivity from the early 20th century. New lands which had been being taken up, there's no sort of more frontier to move into after the end of the 19th century to create new areas for agriculture. There's an ending of projects to improve water supply which had been undertaken in the 19th century, and also reduction in internet. Oh, shit. Okay, I'll just do those two things. Sorry. Now, when we look across the whole of the period from 1858 to 1947, we know that the overall story is relatively slow growth, and so therefore relatively slow productivity improvement in agriculture. In the 19th century, there was some improvement in agricultural output, but that really finishes from the beginning of the 20th century, after which productivity is relatively stagnant. The process of moving out to take up new lands for agricultural activity finishes around the start of the 20th century, and also projects to improve water supply, which had been happening in the 19th century, cease around the end of that century. So in the first part of the 20th century, agricultural output is relatively stagnant. The other aspect of economic activity in India during the colonial period is that industrialisation remains limited. India, as we've talked about previously in an earlier lecture, had been a major cotton textile producer in the 18th and 19th, early 19th centuries, but due to the rise of Britain as a cotton producer, there's deindustrialisation, a shrinking of the cotton textile production in India. Partly that's because Britain, producing this commodity itself, no longer needs to import from India, but also the transport revolution, which lowers the cost of Britain exporting the cotton textiles it's producing to places like India, mean that there's increasing competition for producers in India from British imports. There's a range of other influences which are regarded as having impeded the development of industry in India during this period. The lack of a large local market, by which I don't mean just population size, but a market who had the income to afford the type of industrial manufactured goods which were being produced in the Industrial Revolution era. There was an absence of a capital goods sector, so even though in the 19th century there's a lot of expenditure on infrastructure development by Britain in India, particularly the development of a railway system, essentially that's done using imported capital from Britain and Europe. So the development of railways doesn't lead to any industry in India which is dedicated to producing goods which would be part of the railway industry in India. There's also the issue of the relative price of capital and labour, that labour is so, with India having a large population, the price of labour is so cheap compared to the price of capital that it creates an incentive for producers to be using labour-intensive methods of production. So there's not the impetus to industrialise by introducing new capital equipment as there had been in, for example, Britain and other parts of Europe. Another key factor is a slow pace of development of the finance sector, which, as we've seen, has often been an important contributing factor to industrialisation and economic development. A major issue about this period is, of course, whether the colonial system itself can account for the experience of economic development during this period. And I should emphasise here that what I'm talking about is the effects of the system on economic development. Obviously, there are major effects on political life and on society which are separate to the effects on economic development that I'm talking about here. On the one hand, as I've been describing, it would be wrong to attribute all of the slow economic development during this period to the colonial system. There are also structural dimensions of the Indian economy which caused it to grow slowly. At the same time, it's interesting to note that once we get to the 1950s and there's an Indian independence and a nationalist government and an orientation of that government towards achieving higher rates of economic growth, that the Indian economy begins to grow more strongly. So one influence of the colonial system, I'd argue, was that it meant an orientation towards running an economy not necessarily in the interests of developing that economy as rapidly as was possible. Now, there are other aspects of the colonial system which are also debated. For example, it's argued that one reason India didn't perform well during this period was that there was a net outflow of resources from India, that India was being exploited, that resources were being expropriated by Britain. There's counter-arguments to that say, well, no, in fact, India was a major area of expenditure for Britain. For example, financing the railway system. So there are arguments both ways about the actual resource flows. But I do think that it's important to recognise the break in economic growth that occurs once independence occurs, and to think about the issue of orientation of the group running the economy, whether that's towards economic development occurring as rapidly as possible.